Hello, everyone. Today on a special Thursday Wrap the Week edition of the Final Bar, we'll talk about the market overall drifting higher through the course of this week. Lighter volume, which is pretty normal for a holiday week. The end of the day today, though, on Thursday, really giving back most of the gains of today. We gapped higher and sort of finished back toward the close from yesterday. So, strength and weakness at the same time as the S&P sort of fails and reestablishes resistance. What's next going into next week? That's what we'll work on together. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the markets together, try to learn about what we're seeing, understand the momentum shifts, understand what's working, what isn't. Most importantly, connect the short term, what we're seeing today, with the long term. And today is basically treating it like a Friday because the market's closed for the Independence Day holiday here in the United States tomorrow. So we're wrapping the week. We're taking the mailbag questions. We're trying to sort of, take stock of where we've evolved over the course of this week and how to prepare for next week. And to be honest with you, as a quick preview of what we're going to talk about, I think this week sort of further established the trading range that we've been in. To be honest with you, I think both bulls and bears can feel in some small way validated by what we've seen. Really didn't break one way or the other in a way that would give the follow through, give the satisfaction of one side or the other. I think we're sort of chopping around. I think the end of today really solidified this as a really key trading range. We're going to look at the charts together here in a minute, but just as a reminder, we have a lot of great guests. This week was fantastic with Jim Smith joining us. We had Scott Smith yesterday from briefing.com. Next week, we have some wonderful guests as well. As a reminder, tomorrow we're going to take the day off. I hope everyone is able to celebrate in a responsible way, given the condition we're in. But I hope everyone has a great Independence Day holiday, 4th of July holiday. Next week, we have Clive Lambert joining us from London. He runs a firm called Futures Techs. On Wednesday, Landon Whaley from Whaley Capital Management. And Javed Mirza is joining us on Thursday from Toronto. Javed's a technical analyst at Canaccord Genuity. The week after next, charting the second half is running all next week. I was just talking with Carl Swenlin from Decision Point. I'll be hosting his show with him to talk about his outlook for the remainder of the year. I just talked with Ralph Akampora earlier this week, getting ready to record an interview with him. It's going to be a fantastic week of special guests, of outlooks, of long-term perspective. And we're going to finish the week on Saturday with a market outlook panel. I'm going to be moderating that. It's going to have some great contributors participating with me, and it's going to be an interactive session. We'll be able to ask questions live of our panelists. So make sure you check out the calendar coming up for that week. And as much as you can spend some time with us, we'd love to share the perspective of some really knowledgeable experts going through the rest of the year. Let's move into our Wrap the Week segment. I want to start with a poll, actually. We asked you in a couple different places, and we ran this poll on StockCharts TV as well as some other venues as well. Which asset class does best over the next 3 months? And I gave you the choice of rocks, scissors, and paper. And basically, the idea of that came from an exercise we would do as a team at Fidelity when I ran the group there. We'd always talk about rocks versus paper and think about hard assets versus soft assets and what that means. So I've added scissors, which is basically, think of clipping coupons on a bond certificate, and that tells you why bonds are these scissors form. The results are split almost perfectly between rocks in the form of gold and paper in the form of the S&P 500 in the form of stocks. So about 45% of you answered both of those. A lonely 9% offered the answer of bonds, which is interesting to me. We're going to talk about, if you look at the returns over the last year, the two of these that stand out up over 20% over the last year, gold and bonds. The S&P is up maybe 7-8% over the last year since July of 2019. So it's interesting if you look back over the last 12 months, Gold and bonds have actually been number one and number two. But having said that, I think you've picked up on what the charts certainly seem to be validating. The chart of gold, we heard from Jim Smith earlier this week. We've looked at it a number of times. Certainly building momentum and trading to new highs. Stocks, I think, are in sort of wait and see mode. If I had to answer that question, I would probably say rocks. I would answer gold, although bonds might be second for me. So I'm certainly not as optimistic as many of you are, and I have been wrong before, and it won't be the last time. Let's look at some of the charts together. Let's think about how we can answer some of those questions together, thinking about the setups that we're seeing in terms of what happened today. If you look at the little preview chart, we gapped up, and to be honest with you, a holiday weekend, especially the day before a long weekend, usually is met by lighter volume, which has been the case this week. It's met by sort of flat to higher prices, which is what we've seen. So this is not much of a surprise, sort of what you'd expect with this sort of week. And I think, to be honest, it sets the stage for next week, which is everyone coming back. This was quarter end. This is a lot of weird things happening this week. Next week, we're sort of, quote unquote, getting back to normal. We'll see what sort of follow through we would get. The way that we ended the week was in a period of weakness, and the last hour going into this holiday weekend was met by selling. So the S&P was up above 3150 about an hour and a half ago, and it closed actually up just under 0.5% to 3130. So still an up day, but again, I love to look at that first 30 minutes, the last hour, and just see what sort of indications you can get. And we sort of are heading into the long weekend in a stretch of weakness. Mid caps and small caps actually right about in line. They're all finished up about 0.5%. The VIX is back below 28 now. Looking at other asset classes, we asked about bonds. Bonds actually finished just above flat for the day. They really chopped around. They opened up pretty low and then sort of came back up and traded around the zero level. That's about where they finished off. Yields down a little bit today. On the commodity side, gold finished just a little bit higher. Actually gapped down, but moved higher through the course of the first hour of trading and remained relatively strong. So commodities as a whole, stronger rather than weaker, although it was a mixed bag with silver lower and gold stronger today. And again, I've thought a lot about Jim Smith's comments, super bullish on precious metal. So it's interesting to see how the charts evolve relative to what he had talked about. Now let's get into some of the details wrapping the week in terms of other quick movements. I don't have a lot I think I need to update you on, just because as in general, the way that I would always think about this on the institutional side, you don't want to draw a ton of conclusions from a shortened holiday week just because the volumes are light. So any movements that you would see are more kind of, less meaningful. They're more just sort of getting things lined up, keeping things going until we get back for real on Monday. So let's focus on some of the long-term trends and how they've evolved. And what we're going to do is focus on the Mindful Investor Live chart list. I don't give myself enough time to get through all of this, so I'm going to try to do a little better today, and we'll see what we can come up with. So we're going to start with what I call the market trend model, and again, it's something I've developed over years, and a number of people use some form similar to this to understand the long-term trends. And if you followed what we talk about on the show here, I think you can see my goal is not to follow a model like a robot and just systematically do it. That's certainly not my style, but I also see the value in having some discipline behind what you're doing. And so for me, models are an input to my process. They're not an output of it, meaning I like having models running in the background. I like running screens in the background. I like looking at the results and going through them and evaluating them as a strategist, as an analyst. But in the end, I want to make the call based on the weight of the evidence that I see. And the models are part of that. It's a key input into that. So, overall, as I see signs of weakness, as I'm sure can pick up on the language that I'm looking at, noticing divergences, noticing weakening breadth, I have to acknowledge the fact that the trend has been positive. And when you look at the weekly chart, you don't see short-term consolidation. I mean, you see short-term consolidation, but I mean, the long-term trend certainly appears to remain positive. Higher highs, higher lows. If you look at the swing highs and lows, those continue to ratchet higher. So this last couple weeks, this last month certainly just feels like a healthy pullback within the context of an uptrend. And so that's when the model is telling you long-term bullish. I think that feels about right. I get why it's saying that, and I can live with that. On the medium term chart, it's also bullish, and that's based on the weekly PPO or the weekly MACD. That turned positive sort of beginning of May, and that was after really the market had rallied significantly. Remember when we were facing right around this point, we sort of had that next sort of push higher, and then we broke above 290 up to 300 on the spiders. and approaching 3,000 on the S&P 500 certainly validated follow through to the upside, and I think that's where we're at. The short-term signal has sort of jumped around. Technically what I do is I look at the difference between these two moving averages, and I just consider that a short-term signal. To be honest with you, the real short-term read I use is looking at the daily chart day to day, which is what we'll go at next. But based on this as a system, short-term back to bullish because we're higher than we were last week. So these moving averages are spreading out. So the market trend model that I follow is short-term, medium-term, long-term, all bullish, and that makes sense. I get it. And for me, the question now is, what signals can I start to uncover that would indicate to me some potential weakness, right? If everything is going great and I'm happy being long or assuming further uptrends, what would indicate to me a reversal of that or an exhaustion of that uptrend? So let's go to the daily chart second. Today was interesting. And again, I'd hesitate to draw too many dramatic conclusions based on today because it's a lighter day, lighter volume, less participants, less of a pure read on supply and demand. It's more just an indication of limited conclusion. But I have to acknowledge the fact that we traded above 3150, which we've talked about as being a key resistance level from the middle of June, right? We sort of, it was the first rebound after the big gap down second week in June. We sort of hit 3150, bounced off of it 3 out of 6 sessions, and then pulled back. We're now right back up to that level. And earlier today, it felt like, this is actually going to follow through to the upside. So I'm starting to think, is that going to be enough? Are we going to have enough volume to make that feel like that's a follow through? And what's interesting is we actually finished back toward the lows, which in some way further validates that 3150 level as resistance. So what we've talked about is in the short term, we're sort of bouncing between 3,000 and 3150. If you widen that out to, I think what the key trigger would be, it would be 3,200 on the upside, which would be, sort of here, maybe 3,230, which would be the peak from the first week in June. On the low side, you have around 2,960, 2,970. That's the low from the second week in June. We're right in that range. And I think we've established this short-term range as being pretty important. We're between 3,000 and 3,150. And until we break out in a meaningful way from one side or the other, I think you have to decide overall that the short-term trend remains sideways. The fact that on that market trend model, it's flipped every week from bullish to bearish sort of confirms what I think we've seen here, which was we're range bound, and that's fine. It's an interesting thing. I've had plenty of questions on this model. I've threatened to write more of a blog post, which at some point I will certainly get around to doing. But, one of the things I thought about as I first created and sort of started using this more and more is I basically have a binary output. It's either bullish or bearish. I don't have a neutral version. If I did, it probably would be reading neutral in a couple of those for sure. Breadth is an interesting one. Earlier this week, this started to look a little more negative. And we've bounced off a little bit. Overall, I still think that the pattern is leaning more bearish because we've made lower highs and we've technically made a lower low. And until we make a higher high and sort of invalidate what we saw there, I think I have to assume that breadth on the NYSE, on the mid caps and the small caps has tilted short-term negative. It noticeably did not do that on the broad S&P 500. So here you actually have a pure consolidation, lower highs, higher lows, exactly like the chart of the S&P. And again, in general, this cumulative advanced decline line is going to break one way or the other. I would not be surprised if the direction we break from here really gives us a lot more information about what to expect over the coming month or two, because I think that'll indicate, now that we're in a consolidation phase, give us a signal that we're breaking out. And I think that's what I would be looking for. I haven't seen it yet. In terms of new highs, new lows, this has been pretty limited. And again, it's just, if you look at where the S&P is relative to its high and its low for the last 52 weeks, we're pretty far away from both of those. And I think for most stocks, that's kind of where we're at too. There are a handful of names that are making new highs, and it's the things that would be like at the top of the scooter rankings, stocks like Tesla and Amazon, Netflix, these sorts of names that have gone to new highs and have established new 52-week highs. But again, it's a very small number relative to what has normally happened in a bullish phase or in a bearish phase. You'll get an exaggerated number of new highs and new lows. It's been very muted since March for understandable reasons. One measure of breadth we've looked at a lot is what percent of stocks are above their 50 and their 200-day. On the bearish side of the ledger, if I'm listing out all of the evidence that I can see, the fact that less than half of S&P names are above their 200 days certainly, is an area for concern. And the number's even lower if you look at the New York Stock Exchange, if I believe it is true. the S&P 500 is back above its 200-day, but less than half of stocks are also doing that. And so that tells me that it's less names, big cap names that are driving the index higher. That's just how the math is going to work on that. It's interesting to see that we actually, for a bit over the last day or two, had less than 50% of stocks above their 50-day moving average. That actually bounced back up yesterday to just below 70%. I'm not sure how things are going to end today, just because it was. We don't have that value locked in yet, but I'll be looking at that for sure over the weekend to see where that nets out. But, in terms of a long-term read, I feel better as a bull if over 50% of the S&P was above its 200-day, and we haven't seen it yet. Sentiment, as we've talked about, I use sentiment as an anecdotal piece of evidence. I would never trade off of an indication like the AAII rankings or the Ridex flows or something like that. But I always find it very interesting, just like I would find, some huge investment theme on a magazine cover. I think it's really compelling, and hopefully it leads you to start digging deeper as to why the results are a certain thing. Why is an investment theme featured on, Time magazine, for example, is one of the things we would always do here. So again, it's not a system for me. It's anecdotal evidence, but I think it's important because it shows you, with readings that we can get, what are people voting bullish or bearish? And it's actually been a narrowing of sorts. You have less bulls and you have less bears. Overall, it's still about 2-to-1 favoring bears over bulls. So don't get me wrong. On net, it's a bearish read, and you can see that from the gap between the two. That turned negative late February and is not turned back to the positive side. But I thought it was interesting. Just incrementally, you're seeing less and less conviction on the side of the bulls and on the side of the bears, and that's about how things are netting out. We only have time for maybe one more chart, and the last one I have to show you too. I'm so sorry. Number one, we've looked at small caps outperformance since the March lows, and that's, if you look at the long-term chart, this is a huge downtrend since 2014, probably showing small cap underperformance. But what's happened since March, small caps have actually been outperforming. What's interesting is if you take a trend line using the lows, this is not a beautifully drawn trend line. We haven't broken it quite yet. This is more of a quick sort of pencil drawing of the uptrend. But we're at the lower end of this channel. If you consider this a channel coming from the lows, we're dangerously close to starting to break down through that trend line, which would indicate to me rotating back away from small caps. And the last chart I'll leave you with is the outperformance of growth. I again have heard so many times the return of value starting to work. The ratio of growth to value still very clearly favoring growth. I haven't seen that change materially yet. So it's still telling you to lean into the growth trade away from value as you can. We'll take a quick commercial break, folks, and we'll be back with our final bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the final bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us for our show every day. As a reminder, you can get questions to us anytime you need. The final bar at StockCharts.com. I find a lot of people send questions over the weekend when they're spending time digging into the charts when the markets are closed. That is totally fine, and we'll get to your questions early next week as soon as we can, or on Twitter at FinalBarSCTV. Just tag us in a comment, and we'll get your question as soon as we can. Let's get to the final bar mailbag. And these are all questions we've received from you in the last day or two. And you guys sent some really thoughtful questions. I appreciate it. Question number one, but I'm skipping compliments on the show, and thank you so much. How do I get the mutual fund cash ratio information? How often is it available? There are a standard set of charts. Yeah, you asked a lot of questions about this. Yeah, really good question. And so the short answer is yes and no. Your question actually led me to debate this with my boss, Chip Anderson, and we came up with the answer of no. We stopped tracking it actually a couple months ago, maybe end of last year. But having talked about that, we talked about re-upping it, and I'm giving me just a second here. I think I have the chart saved in one of these. I don't. I'm so sorry. I was not prepared to bring this up here. But I have it somewhere, so I'll just skip it. So the short answer is yes, we actually do have an index that tracks mutual fund cash. It's not been updated in a little while, and my conversation with Chip, I sort of confirmed, I think this is something we need. So I'm actually working with him to come up with some other things that sentiment-wise, breadth-wise, that I think we could be adding. We're going to take a look at the list and get them set up as soon as possible. One thing I would tell you, though, is this: something like mutual fund cash percentage. So what you're talking about is basically what percent of mutual fund portfolios are in cash right now. And historically, that actually was a really good gauge because fund managers would rotate out of stocks and into cash. They'd raise cash when things were getting bad. When things were getting well, they would allocate as much cash as possible into stocks. And they would have according to the structure of the fund and their prospectus, they would have a certain amount they would have to keep in cash just to manage redemptions and sales and stuff. But overall, it was an interesting measure, but a couple things have happened. Number one, I think that's changed a lot. So most funds don't hold a lot of cash as much as they probably did before. And I think that's for a number of reasons we can't necessarily get into in depth here. Number two, you used to actually get paid for holding cash. You get some sort of interest on it, which would mean as a money manager, you would actually at least get the interest on the cash, right? As a money market or something. But that's essentially zero. So one of the things we would do is actually look at the ratio of mutual fund cash versus like the 10-year yield, because you would want to normalize things based on, well, how much you're actually getting for holding cash. And then you actually see how motivated would money managers be. And so the problem is, because interest rates are at lows and because they've been so low for so long, there's very little reason for a money manager to want to have cash unless things are really getting horrible. And if you look at the mutual fund cash ratio, it's not been very high for a while. It's been relatively muted. Having said that, I'm going to dig into the data a little more. And as soon as it's ready, I'll announce it with much excitement on the show. Thanks for that question, by the way. Question number two, are you a follower of the Daily Sentiment Index? I read a lot on financial markets, and different people have been referring to it. They don't give a source for it. It's indicating things are a little elevated. Yeah, I'm guessing what you're talking about. There's a Daily Sentiment Index that's fairly widely followed. It's Jake Bernstein, I want to say, created it. And I know that from being at a money show and talking to some people about that as well. The short answer is no, we don't have a Daily Sentiment Index. There, the sentiment indexes we do have. If you search for keywords, you'll find some different ones. You can see the main ones that I follow on my chart list here, daily sentiment. So AAII is a survey based on individuals. The name exposure, the RIDEX flows are really looking at flows and how people are allocating more to equities or less to equities versus other asset classes. And then the put call ratio is the last one, the VIX. I bucket in the forms of sentiment as well. They all are calculated very differently. They all give different reads. The daily sentiment index in particular, if I remember Jake's work, and I'll have to go check on this more, I think it's based on futures and it's relatively short term. But I'll look at it as I mentioned with the mutual fund cash ratio. Listen, we're always looking for things like this. If there's stuff that you don't see that you want to look at, please let me know. Shoot us an email, and part of my role is to dig into some of these things and see how we can improve the stuff that we're showing you. So I'll take a look at it. But I believe you're talking about the one from Jake Bernstein. If you Google it, you'll see some information about it. Next question. Your speaker this week used some terms about Heikin-Ashi styles on your show. Yeah, sorry. I thought about that afterwards as we were finishing the show, and I let Scott Smith go. He's the technical analyst at briefing.com. He joined me yesterday. We talked about Heikin-Ashi candles. I'll show you where you can find them, and I apologize so much. I thought about that. I'm like, we just kind of blew through what those were. We didn't really spend enough time on it, so sorry just for timing. So I'm glad you asked about it. Here's the way you do it. On a regular chart, go below it, and here where it says type, you can say open, high, low, close bars. And you can also say candlesticks. So candlesticks, as you may or may not know, hopefully you do, were created in Japan, and the story goes back in the 1600s. A famous rice trader whose first name escapes me, his last name was Hama, Homma. And just like we might talk about Jesse Livermore or Charles Dow in Japan, they'll talk about Hama as being a legendary trader and trying to emulate him. And basically, he was a rice trader and created candlesticks as a way to understand rice prices and selling rice and buying rice. That was probably a very meager history lesson on Japanese candlesticks, but there you go. If you click on the type of the chart and go down here to Heikin-Ashi, this is what it is. And the translation of that, I think, is average, like average bar or average pace. I think I've seen it in different ways referred, but basically just means like an average step to the chart, an average bar. How does it go? So, thing to remember is it basically looks kind of like a candle chart, but instead of a candle chart shows you open, high, low, close, the Heikin-Ashi chart actually calculates the open, high, low, close using different metrics. So for example, the close of the bar is actually the average of the open, high, low, and close. So it kind of takes a median price of sorts, and that's the close. So it smooths out a lot of the noise. You'll see in big down moves, it just looks like a series of black bars, even though the trend was actually up and down, but because it's taking averages, it smooths all that over. So when you have a series of big black bars and then you start to see some white bars, it tells you that things have changed a lot. When you saw the rally in June, then you see it flip down on Macy's the second week in June, it sort of obviously turns lower, and then indicators and everything can be calculated off of the Heikin-Ashi charts. And that's actually what Scott Smith was showing us yesterday. He was showing that on-balance volume that was based on Heikin-Ashi candle. So, could come out a little different results. We do have a Chart School article and some information on that. If you just search for, click on the little magnifying glass and search for Heikin-Ashi, and it's spelled Heikin-Ashi. You'll get some information on it. It tells you a little bit more about how they're calculated. I sort of blew through it. The very final question, and then we have to move on. Question: I enjoy your program. Gives me a good sense of market conditions at the end of the day. When I wake up at 5:30 a.m., you mentioned you're on the West Coast, I'm quickly hit with overnight news, pre-market moves. I have to resist the temptation to be drawn in emotionally by the fear of missing out. I love your behavioral question here. What indicators, charts would you suggest for reviewing pre-market to give a good indication of the market conditions? Yeah, so, good question. And I would say, honestly, on StockCharts, we have limited information about pre-market trading, after hours trading. We just started to introduce it earlier this year, and we have a function called symbol summary. So I would tell you around a company reporting earnings, you could absolutely bring up a simple summary. You can see where a stock is trading as they release it and if there's some unusual movement. But having said that, on average, we don't do it a lot. To be honest with you, I look at 2 places, 3 places maybe to get a read of things. But my first answer would be resist the temptation of being drawn in emotionally by the fear of missing out. I think that's the number one thing. I will give you these things only if you promise that you will do your best to look at long-term charts first, and then at the very end you can get a cup of coffee and look at how futures are trading, because you don't want to get too sucked into the short-term movements. Having said that, I look at marketwatch.com to get a read on futures because they show the E-minis all night. I'll look at briefing.com. Scott Smith joined us yesterday. I learned of his work by subscribing to briefing.com, which is all news, things we don't really have on our platform. They do a really good job of just covering what's happening during the day and also what's moving things, pre-market, post-market, and so forth. And then I look at Bloomberg, and that just comes from institutional time. We would always pay attention to Bloomberg as sort of the news of record, and so I've continued to follow the headlines there. Thanks for those great, thoughtful questions. I feel like I hit on a number of things that we haven't talked about before, so happy to do it. And we need to wrap the show, folks. Go to the 3 in 3. Here we go. Chart number 1 is the S&P 500 with on-balance volume. I'm using the spiders here. And, as we've talked about the S&P in consolidation mode, now fading off of a key resistance level around 315 for the spiders, you have 2 conflicting volume messages. Volume has been lighter over the last couple weeks. The heaviest volume days have been the down days over the last couple weeks. You can see the volume this week certainly weakening, the bars going lower and lower. So that's all sort of more cautionary. The validation of the uptrend is the fact that the on-balance volume continues to go swing higher. So it's showing you that even with net of the down days, the average volume picture is more on up days than down days. Second one is looking at the bull-bear spread on the AAII rankings. Again, this is survey data from individual investors. I think the noteworthy thing is that there's been a reduction of conviction on both sides, less bulls, less bears. So there's that. I think that sort of plays into this consolidation theme we're looking at. And that's been the last couple of weeks we've seen it, but also the fact that it remains about 2-to-1 voting bearish versus bullish. So even with the markets rallying a little higher, we really haven't had strong conviction of a turn there from individuals. Finally, growth versus value. Again, over my career, I've heard of the return of value so many times. It has still not worked yet because anytime you see volume start to work, growth overtakes. And I think the Fangman trade, even with the bearish divergences we've seen, the strength in the Qs and the NASDAQ 100 continues to impress. The XLK outperforms. Growth is continuing to outperform value until proven otherwise. Folks, that's a wrap for this week. Thank you so much for joining us. Please keep your questions coming to us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great long weekend. Happy 4th of July. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.